87% of realtors get into the business and get out of the business in 2 years. That doesn't exist in our world.
We have massive visions around growing our businesses, and we are always looking to add talent to our world. We do everything in our power to ensure the people we surround ourselves with defy the odds, get into production, and build massive lives for themselves.
If you are a realtor looking to get into the business, we have a blueprint for success.
With locations all across Canada, reach out to us. Let's talk about partnership and opportunities. We are looking forward to it.
Hey guys, welcome to another episode of the Sales Piece Podcast. We're here today with David Giustizia of Mortgage Alliance. David is someone we work with very closely and he's extremely knowledgeable on the market, and that's what we're all looking for in this tough market. Rates just went up 1%, not something I was expecting. And it raises a lot of questions. Where are we going and what impact is this going to have on us as realtors and on our clients as we move into the future? So David, thank you so much. I really appreciate you joining us today.
Yeah, thanks so much, Mike, for having me.
Yeah, before we get into everything that's going on in this crazy world, could you maybe share a little bit of background on yourself?
Absolutely. So I come from the wealth management space. Actually, prior to this, I spent some time both in the banks doing funding and wealth, as well as in some boutique firms. And so when we kind of approach our client discussions and how we approach our team is a very holistic approach in terms of looking at kind of the overall client picture, understanding exactly what they need and how we're going to go about taking them through all the steps that they need to get there. So we actually, myself and my partners who operate two mortgage teams, we have Vision Mortgage Group, which is our residential division. So that deals with first-time home buyers, refinances, self-employed clients, residential investors. And then we also have Vision Capital Partners, which is our commercial arm. They take care of large apartment buildings, industrial finance, land development, that type of thing. So we, as an amalgamated team, we deal with mortgages for pretty much every possible situation. And so we've been doing this for quite some time now, and we have a team of 12 behind us, all wonderful people that specialize in their own areas that can kind of help the clients get to where they need to go and help them plan out that vision.
That's awesome. So help get the clients to where they need to go, help get them to their vision. How are we doing that in this uncertain world? I know we spoke offline about some of the challenges your clients are encountering. Can you speak to that maybe?
Yeah, I think, for most of the clients that we see, it's a couple things. And, every client's in a very unique position, right? And for many people, having their mortgage is just about, owning a home and trying to become mortgage free at its, at its simple core. And so a lot of the discussion right now, both for people that are actively looking for homes or people that are already in homes, perhaps with variable mortgages or perhaps with fixed mortgages coming up to renewal, are what do I do now? We've seen interest rates effectively more than double in the past 6 months. What kind of approach do we take? Should we be in fixed? Should we be in variable? How does this impact my affordability? How does this impact my ability to pay off debt? For those coming out of variable mortgages at many of the big banks where the payment doesn't change as the rates go up, people are looking on their online banking, they're seeing 40, 50-year amortizations. We're getting very close to perhaps the first batch of what's called trigger rates, where people who haven't seen payment changes because they have that special type of product are going to get a note from the bank saying, hey, you either have to increase your payment by this amount or you're going to have to write us a big check. Because your payment is no longer even covering the interest on your mortgage, never mind paying down the principal. And so, our starting point with everybody is really understanding what is it that you want to accomplish, right? What is the end game? And that is different for everybody. For investors, it might be, I want to take on as much debt as I can because I want to leverage as much as I can because I want to acquire as much as I can. For many other people, it might be just how can I pay this off in the most cost-effective way? How can I get myself to a debt-free position? And it's the balance of uncertainty. It's not understanding where things are going. I pulled a quote for a presentation we did a few months ago, about 12 months ago from Bank of Canada. And in that quote, their guidance was that rates would not move until 2023. And at the time that they started moving rates in 2023, rates would be moved slowly and cautiously. We've now seen 9 rate hikes in 4 months. So, that guidance for those people that were making decisions based on that BOC guidance last year, what we understand is that things are dynamic. Just because that's the information that they were providing in the summer of last year doesn't mean it's something they're going to adhere to. And there's a whole bunch of reasons why that's happened, but it really comes down to what can we do to make the most of the situation we have today, and how can we situate you into the best possible position to manage your debt load.
So I want to bring it back just a little bit for people listening that are either new to the industry or still understanding kind of what this world can provide. But what were some of the biggest reasons why the Bank of Canada and the government of Canada decided to make all those rate increases in the last couple months?
Yeah, so I'll tell a little bit of a story, I guess. So we saw coming out of 2019, rates were on the rise, and the projection was they were going to continue to do so. I'll try and keep it really at the fundamentals. So Bank of Canada, one of their mandates is to manage inflation. And one of the ways that they do that is with the overnight lending rate, which is correlated to the bank prime rate, which determines mortgage rates. And so the Bank of Canada uses what's called a neutral zone. So when their overnight lending rate is between 2 and 3%, and after this last rate hike, it's now at 2.5. So today we're right in the middle of that neutral rate. That rate is such that it's neither spurring economic growth, right, nor is it putting drag on the economy. It's what they would call a neutral stance. And so as we were coming out of 2019, we were approaching just borderline getting back into that neutral zone, which is kind of where they want the long-term rates to sit. And then COVID hit, right? The world shut down March of 2020. Nobody knew what was going on. Nobody understood what recovery was going to look like and how badly this was going to impact us. So the Bank of Canada made a series of very quick rate drops, and in a pretty expedient manner brought the overnight lending rate to 0.25, so almost nothing. And so the understanding was always going to be that as the economy recovered, there would be this rise back up to achieve that neutral zone where they want to be. But then what happened over the past 6 months, as the economy started to recover, COVID restrictions started to lift, is we saw crazy inflation numbers that haven't been seen in years and years. And so, what that means is that the prices of everything are going significantly up, 8, 9, 10% inflation in an economy that typically sees, 1 to 3%. And that is the Bank of Canada mandate, to keep inflation between 1 and 3%. And so what's happened is they're seeing strong economic growth, they're seeing good employment numbers, they're seeing good business recovery, knowing that they have to start raising these rates irrespective of inflation. They aim to get back into the neutral zone. But now they have to jump, and they have to jump quickly, because the way that most central banks battle inflation is with increasing interest rates. And so, that has been the spur as to why the guidance from them 12 months ago was, hey, we might start kicking this off in 2023. We're going to do it slow and steady. And then, you turn around, you come into, March of 2022, and they kick it off with a rate hike followed by a double, followed by a double, followed by a quadruple in rapid succession. And now that we're in the neutral zone, the expectation, the guidance from them is we're actually going to need to go beyond that neutral zone. So now it's not just about getting the rates to that point of stability where it doesn't spur growth and it doesn't detract from the economy. They need to actively push it above to aim to tame inflation, right? And so we're actually seeing that on a global scale right now, for the most part. While there are a few holdout countries that we're seeing in Europe that don't believe that the rate changes are going to work. So there's still some areas where you're seeing these super artificially low rates, but we're seeing everybody in most of the developing world battling the same problem. So this isn't a unique to Canada situation. We're seeing it in the States, we're seeing it in Europe. And so that's really the reason behind this big push and this big accelerated movement that's, far faster than anybody had anticipated.
I know it's probably very hard for you to answer this, but it's a question I get from my clients a lot. How long or how far will the Bank of Canada continue to push the rates up? Because do you guys have any insight as to when they'll stop and when inflation will round the curve and actually start coming down? I think for some of our clients, probably all of us, we're all in a similar age group here. I know stories I hear stories from my parents back in, I think, late 70s, early 80s, their rate was 15, 16%. I now have clients asking me, Mike, do you think it's going to get to that point? I honestly don't know the answer. I know it happened in the past, so I guess it's possible it could happen again. But what's your take on that?
Yeah, so a couple things. If I take my opinion out of the equation for a minute, where do we get our information from? That is a really good starting point. So the economists at our big six banks, so the big five most people know about plus National Bank, that less people talk about, tend to be the prevailing source for this information, right? So the banks internally, in understanding what their year is going to look like and their products and their rates and their volumes and everything like that, they're doing these assumptions, they're doing their modeling to determine where do they think this is going to end, how do they think it's going to play out. So without getting into too deep of specifics, if I kind of just amalgamate the guidance, I will say a few things. Number one, the banks are not in agreement. So we are seeing some banks say we think this is going to happen, and we see some banks saying we think that's going to happen, and those two things are vastly different. And so there's not kind of a concurrent consensus on here's where it's going to go, here's where it's going to stop. But if we kind of amalgamate the data, the expectation is 4 to 5 more increases, which would put the overnight lending rate at 3.5 to 3.75, which would be somewhere between a half a point to 75 basis points over the top end of the neutral rate. And we'll see that as we ride out the rest of this year coming into early 2023. Expectations for inflation cooling are really varied. Some are thinking as soon as 6 to 8 months, some are thinking like a year or two out. But there is a pretty good prevailing consensus that they then expect a pullback in rates coming into the end of 2023, 2024, coming back towards that neutral zone. Remembering that 2 to 3 range is where Bank of Canada wants to see the long-term interest rate environment, right? And right now, today, we're right in the middle of that. So the expectation is very unlikely to see the rates we had during COVID ever again, and barring some other massive economic shock. But that will likely push forward from here another 4 to 5 increases, but then at some point probably pull back perhaps into the range we are today, but the jury's kind of out on exactly where the chips are going to fall on that.
Okay. And then
we don't expect massive double-digit interest rates. I think there's a deep understanding by both the central banks, sorry to cut you off there, Mike, but both by the central banks as well as the governments, that the Canadian debt loads as a percentage of our incomes, as a percentage of our GDP, is very high in the developed nations, as well as the government debt loads. And they understand how much of Canadian wealth is now stuck in real estate. And so I think there would be a huge hesitancy for them to knowingly entirely collapse the real estate markets, right? They're happy with some cooling. They don't mind some pullback. Do I think they're going to be comfortable seeing 60% declines in house prices? Absolutely not, right? So there is going to be, I predict, there's going to be a somewhat of a limiting threshold there, where there is going to be a point at which they do have to make the decision that even if inflation hasn't been cooled, chasing after cooling inflation at the cost of just continuing to raise interest rates is not going to be an effective method. And that's what we saw in the 80s, right? Where it peaked up around 20, where it just became this methodology of like, inflation's not stopping, let's move them again, let's move them again, let's move them again. It almost became like a self-fulfilling prophecy. And so we spent, 35 years recovering back downwards to the rates we have today from that. But that's kind of where the general economic consensus sits on this right now.
Okay. And for anyone wondering, 4 to 5 increases, what does that mean in terms of percentage points or basis?
Yeah. So sorry, that would be, so typically when we say increases, we're talking about 1/4 of 1%. Now,
Okay.
Sometimes they'll do double increases, which would be 0.5%. The most recent increase was a full percent, which I would typically call like a quadruple increase. So that would mean another 1 to 1.25%. So most of the banks' prevailing prime rates, which is what most people are interested today, is 4.7. So that would mean perhaps topping out with prime ending up around 5.95 if everything follows along that trajectory.
Okay. And then the question I'm getting a lot from our clients is, given the environment we're in today, do we go variable or do we go fixed? I'm sure you get that question all the time. What's your recommendation?
all the time. The recommendation, much like financial planning and wealth management, is that there isn't really a one size fits all. If you look at the last 40 years, those in variable have done much better. If you look at the last 40 years, we've also had a fairly steadily declining interest rate environment. But I think, the reality for that is it comes down to understanding how each person is positioned, what they're using the money for. Is this a primary residence they're trying to pay down, or are they a serial real estate investor trying to buy more properties? But one of the things that we're seeing is that spread between variable and fixed, that premium you have to pay to get to a fixed rate, can be quite substantial. So we're still seeing insured mortgages, meaning, buyers with less than 20% down, where variable rates are, prime minus 9, or prime minus 0.9, meaning that they're getting in rates right now at, 3.8 or thereabouts. We're fixed in a lot of those lenders are, borderline 5, maybe a little bit over 5. And so that extra price that you're paying is quite a premium to lock into fixed. And when you look at mortgage rates, sorry, this is kind of a sidebar, but it's important. The fixed rates are driven by a different set of instruments than the variable rates. So the variable rates are driven off the prime rate, which Bank of Canada has direct control over through moving the overnight lending rate. The fixed rates are driven by the bond yields, and the bond yields are like stocks, traded every day. People buy and sell, and depending on supply and demand, a price gets set and a price changes. And so what that means is, if we assume a reasonably efficient market, that the pricing of the bonds is including all of those future expectations, right? So those investors where the bonds are sitting and driving those fixed rates, take an example, let's say the fixed rate was 5.1 and the variable rate was 3.8. Well, what that tells me is that, those bonds are pricing in 1.25% in movement, right? So when that 1.25% in movement happens, that variable rate's now gone from 3.8 to 5.05, which is 5 basis points below that 5.1. And so a lot of that has already been priced into the fixed. And so if we believe that the rates are going to peak but then come back down to where they are now, predominantly most people, if that is what happens, most people will be better served in a variable. But it also comes down to budget. It also comes down to, can people stomach the change in payments? Can they stomach, that ability to have a little bit of ambiguity in where things end up? And if the rates don't follow, the current projections, and they do go up another 2% or another 3%, what kind of position is that going to leave that person in, no matter how unlikely? And so I think that's a lot of the discussion, is kind of this risk versus reward piece, and understanding where you're situated.
Mm-hmm. One other common question that I've been getting a lot is from people that locked in for 5 years and their mortgages are coming up for renewal. Like, what can they expect, or what should they be at least aware of as they're moving forward?
Yeah, I think, the 5-year renewals right now are actually kind of interesting, because those would have been locked in around that 2017 mark, where rates were actually not nearly as low as they were during COVID. So you weren't seeing the sub 2% fixed rates at that time. The rates are still higher than what those people may have, but I think the biggest expectation I can share is, expecting it, if you want to keep your debt pay down timeline or your amortization the same, you are going to have to move the bar on your payment, right? But for a lot of people, there's 2 choices to make, right? If you simply renew with your bank, you're keeping the existing mortgage balance, you're keeping the existing amortization, and you're locking into the prevailing rates of the day. For a lot of people who might be a little bit more cash flow conscious, and whether or not this serves a bigger picture strategy is going to be unique to each individual, but they're taking the opportunity to perhaps refinance instead and extend that amortization, which is going to minimize the change on those payments, perhaps even negate the change on the payment entirely, in exchange for paying that loan over a longer period of time, which means ultimately over the long term they're going to pay more interest. But for people where affordability is stretched, we're seeing peak inflation in food and gas and all these other categories. At some point there's a balance in understanding that, look, even though this may make your long-term financial situation not as attractive in terms of your debt pay down strategy, for many people, it's just a function of being able to ensure that they can afford to continue their lifestyle, right? And continue to move forward with being able to put food on the table and gas in the car. But I think the most important piece is making sure that, you know, you're reaching out to your professionals, reaching out to your brokers. The spread in lending rates right now is very wide. We're seeing some lenders that are as far apart as 0.5% or more for the same type of product. And that tends to happen when we get into like a super volatile rate market. And so ensuring that you're positioned for that renewal with the best possible lender and making sure that somebody's looking around and understanding what options are on the table for your situation is incredibly important.
Yeah, I think you've made a lot of great points and even kind of opened up my eyes to some things that I'm not touching base on with my agents or even with clients. Now, last question I have for you, and then I'll turn it back over to Mike. But what do you feel is like the biggest piece of advice that you can either give to a buyer or a seller right now?
It's a great question. Two different pieces, probably. For buyers, I think the important discussion for buyers and quite honestly the realtors is understanding that from this point on, so from that last rate hike onwards, every subsequent rate hike is going to decrease the amount of mortgage you can qualify for. So mortgages are qualified using payments, not balances. So when you qualify for mortgage, you don't qualify for $200,000 or $300,000. You qualify for a $2,500 payment or a $3,000 payment, and based on a set of assumptions, that payment then gets backed out into a mortgage size. And so as rates go up, the rate assumption around your qualification goes up. And what that means is a $2,000 payment equates to a much bigger mortgage when the mortgage rates are 3% than it does when the mortgage rates are 6%. And so understanding that pre-approval that you got 2 months ago, for many, many people, you would not be able to qualify for that today. And so for buyers, it's important to first of all, work with somebody who knows what they're doing, because unfortunately the industry in mortgage brokering is quite low. It's a 1-week course, and that's it. And unfortunately in the banking sector, the staff, I used to work at the bank, so no prejudice against them, but the tenure of the staff and the experience of the staff and the branch levels can be widely varied from industry experts who've been around the industry for a very long time and know very well what they're doing, to people that have been on the job and in the industry for 3 months. And so making sure you're working with somebody who really understands what's going on and can guide you in the right way. There's nothing worse than, getting a pre-approval in April, walking to your mortgage professional or bank in July and saying, hey, I bought a house for the amount you pre-approved me for. And they turn around and say, no, sorry, you can't be pre-approved for that anymore. The situation's changed, right? So for buyers to have their finger on that pulse and understand how each subsequent change is going to affect both their affordability and their monthly payments, as well as their ability to qualify for that debt. The other comment I would make, one more piece on buyers. I've seen more deals in the last 3 months around, hey, I bought a home unconditional with the expectation that my home was going to sell no problem, and it hasn't sold. And now I'm in a situation. So just having a really good pulse with your agents on what is the strategy. Are we going to buy before we sell? Are we going to sell before we buy? How marketable is the home that you're selling? How much wiggle room are you comfortable with on, if the market's not willing to pay the price you think it's worth, are you comfortable resetting expectations by hundreds of thousands if that's what it comes to complete your purchase? And so that really piggybacks into the sell side, which is, on the seller's end, understanding that your homes aren't going to be worth what they were worth in February or March. And more importantly, they're not going to sell as quickly. This idea of, we list a home on Thursday, it's sold by Monday in competition. We're not seeing that nearly as much anymore. And so especially if you're tagging it into a subsequent purchase, it's really important to understand that the market has shifted and understand what you're going to do with the mortgage that's on that house. Because for many people that may have locked in previously, there's great rates that they have that they'll likely want to port. And understanding that capability and understanding how that plays into your next situation is also incredibly important.
That's very, very helpful. I don't know about you, Anna, but I think we've covered pretty much everything we hope to today. David, anything you want to add before we wrap up?
Yeah, I guess what I would just add is this is a very dynamic environment. This outlook, the bank guidance, the economic guidance is changing weekly. So, ensuring that if you're in a position that you're looking at a purchase or you have a renewal coming up, making sure that you're being proactive, getting as far ahead of it as you can, and understanding the implications of everything that needs to go into your renewal or your refinance or your purchase in today's market is going to yield a huge benefit. Do not leave things to the last minute. The further ahead of it you get, the better the chances that you're going to be well positioned to take advantage of the best possible cost savings available. And understand that, this market may continue to change and things may shift. Trying to catch that bottom for the buyers is likely not the best approach. We've seen it time and time again, people saying, oh, you know what, market's going to drop again in the next 6 months. If you understand what you can afford, if you understand the situation you're in, finding something that you love, making sure it's something that's affordable, trying to time the market in housing is just as challenging as trying to time it in stocks, which is for most people, it's a coin flip. And more often than not ends up in a worse situation than, had you just gone after what you wanted to go after, making sure that it was well within your means.
I think my biggest takeaway was just like, there's no cookie cutter solution. And that's why amazing professionals like you are around, Dave, that we can go and talk to, get really good glimpses of what's happening, what we could potentially expect, and just overall things to be aware of. So thank you for all your contribution and advice.
Yeah, no problem. And I guess the last thing to mention for those watching that haven't worked with a mortgage broker before is predominantly our services are free, similar to that of a buyer's agent as a realtor. Our compensation comes from the lenders that we work with. So there are some cases where that's not the case, but we're very upfront and transparent for clients that may be in a situation like that. But to be able to have that call and get that guidance and for us to take you through that process or another mortgage professional in the brokering side is certainly something that most people don't have to pay for. And although I do love the banks, because they're only one institution with one set of rates and one set of products in such a dynamic environment, there could certainly be value in working with somebody who can kind of scan the entire situation and your situation and the lending landscape and figure out who the right fit is for your need.
Awesome. Well, thank you so much. Really appreciate it.
Awesome. Thanks so much for having me, guys. Enjoy the rest of your evening.
Every day I'm hustling, every day I'm hustling, every day I'm hustling, every day I'm hustling.